China's economy has seen struggles over the last couple of years, particularly within the real estate sector. It's seen one of the world's most catastrophic real estate collapses of all time. Youth unemployment has also reached a record high of 18.8% this year.
More than 1 in 5 are now officially unemployed, dashing their hopes for a better life.
The economy is experiencing one of the worst episodes of deflation since the great financial crisis of 2008. Now, last month, China initiated the long-awaited stimulus package that is used to combat this spiraling deflation. The Chinese stock market, the CSI, is up over 20% over the past 2 weeks. However, this past week, the rally took a dramatic turn as the Hang Seng dropped almost 10% on Tuesday, October 8th, the biggest single-day decline since 2008. So what exactly happened? And what are some of the longer trends in both consumer consumption and also geopolitical tensions that we need to be aware of as people who are interested in economics and investors? We're discussing this theme with our guest today, Shaun Rein, founder and director of China Market Research Group, and the author of several books, including The Split, Finding the Opportunities in China's Economy in the New World Order, which will be coming out later this month, and The War for China's Wallet, Profiting from the New World Order, written in 2017. Shaun, great honor to host you. Thank you for joining the program.
David, it's great to be here and speak. Both of us are McGill University alumni. So
I know.
It's great to talk to a fellow McGillian during these turbulent times in China's economy. As we said, it's been a rough 3-4 years for people like me who live in China. For those in the audience who don't know my background, I've been living in China for 27 years. I actually turned 47 this week.
Happy birthday.
So I lived in China, thank you very much, for 27 years, while I lived in the United States and Canada for 20. So I'm very comfortable here. And I'm actually doing this interview, David, from my closet here in Shanghai, which is where I was locked down for 3 months during the great Shanghai lockdown of 2022. And I bring that up because there only have been 2 times, David, in my 27 years in China that I've been very anxious, stressed out, and worried about China's economy. The first was at the height of China zero COVID madness in 2022, when it was scary to go outside. If you went outside with your kid and your kid went to the bathroom and was considered a close contact of someone who had COVID, that kid was sent off to a Fengshan quarantine hospital for 2 weeks. So people didn't want to go outside. They didn't want to go to stores. They didn't want to go to restaurants. They're worried about being locked up in horrible conditions. That was in October, November of 2022, where no business was getting done. The second time, David, that I got very nervous about the economy was in August and September of this year. In August and September of this year, we started to see the same anxiety, the same stress, because nothing was going right in China's economy. As you said, Chinese youth employment hit 18.8% in August. Real estate prices had dropped 20 to 30%. The official number said a drop of 8%, but in my neighborhood, which is in one of the better neighborhoods in China, some of the prices had dropped 50%. One of my neighbors was trying to sell a home last year for 50 million US, and this year is selling for 25 million US. So basically, that's a long-winded statement of saying that the economy was on really weak footing in the last couple months, which is why the government had to launch what I consider to be a mini stimulus. I know a lot of analysts in America have called this a bazooka-like stimulus, but I don't think it is a bazooka. The government increased the ability for companies to buy back their shares, increase liquidity in the market, is really done on the monetary policy side, which is why the stock market has gone up. You know, right now, the Hong Kong Hang Seng is the best performing stock index of the year. So there's been a lot of positive momentum there. But the question everybody's asking is this stock market rally sustainable, or is it going to drop? Second is, even if it continues, what is the impact that it's going to have on the everyday economy and consumer spending, fixed asset investment? I think those questions, which we can delve into, remain to be seen. Unless there's a fiscal stimulus coming soon, I don't think the market rally is going to have as large an impact on consumer confidence and spending as a lot of people on the street predict.
Before we continue with the video, I want to tell you about our sponsor today, Caleb & Brown. Bitcoin has reached new all-time highs this year, and many pundits and experts predict the price may go even higher in 2025, which is why it's so important to find a reliable on and off ramp platform to sell and buy your cryptos with fiat currencies. Many investors have struggled with this year, and this is where Caleb and Brown comes in. Caleb and Brown offers over 300 assets to buy and sell directly with all major fiat currencies, and you don't have to experience limits or fees. This, in the fact that there are no trade maximums or withdrawal limits, means that clients can seamlessly place limit orders and stop limit trades. Caleb and Brown has been operating since 2016 and has gone through numerous bull and bear markets. They have a history of consistent uptime, even in the most volatile periods. Sign up now using my link in the description below or scan the QR code here. Let's talk about the stimulus, and then we'll lead into the themes of your book, which is consumption, geopolitical trends, and then ultimately equities markets. This stimulus is a mini stimulus, you said. So I'm reading in Western press, it's the biggest stimulus since the pandemic that China initiated. And just a few facts here. We know that they cut the prime lending rate. We know that they cut the reserve ratio by 50 basis points for banks, which should in theory stimulate more lending and liquidity. We know they cut the mortgage rates as well. So this is a command economy. In theory, they could do anything. And this week, apparently, it was announced that new stimulus measures had disappointed investors, which is why the Hang Seng reversed. What exactly happened this week when Chairman of the National Development and Reform Commission made an announcement Monday night, which disappointed investors? It wasn't enough?
Well, I think with the NDRC meeting, sometimes it's better to say nothing than to have a meeting and say nothing. So I think there was this huge pent-up expectation after the Golden Week holidays that the NDRC was going to launch a major fiscal stimulus. There was a lot of rumors that they would get rid of income tax under 8,000 RMB a month, that they would allocate 300 billion, 500 billion or more towards, new infrastructure projects helping third, fourth, fifth tier cities. The rumors about the fiscal stimulus are good. And if the government actually implements that type of fiscal stimulus, then you're going to have a rally that's going to go on for another 3 to 6 months. The Hang Seng might hit 30,000. But the question is, will they launch that fiscal stimulus? Because the measures you just mentioned, lowering the reserve ratio, that's great, but who's going to borrow money if they can't find a place to allocate the money? When you have the refinancing mortgages, that's great, but the consumers are so concerned about the economy that if they save money from refinancing, they're not going to go out and spend more. The issue, David, comes down to income. Okay, so until Chinese feel that they're going to have a steady supply of income for 6 months or a year, where they're not going to have their bonuses clawed back. You got to remember, a lot of state-owned enterprises, especially in order to help the motherland, have been clawing back bonuses that were already given. So some people were getting bonuses in 2023, and the SOEs were saying, nope, you need to return the money to us. Until the government stops putting caps on salaries like they've done on the financial services sector, like banks, and there's rumors they'll do it for insurance and other sectors. Until you get a feeling amongst consumers that they can continue to get paid, their money is theirs, won't be clawed back, and they won't have salary caps. So if they work hard, they can make more money. Until you get and recreate those animal spirits, I think it's very difficult to convince people to go out and spend more. So that's why I call it a mini stimulus, right? I am a business owner in China. I've run my company for 19 years. I'm not going to borrow any money because I don't know where to deploy it right now. I'm not going to go out and hire anyone because I'm not sure that there are going to be projects in the coming months. Am I investing in equities? Heck yeah, I've gone all in. But that doesn't mean I'm going to take those earnings and go out and spend. I view this as a once-in-a-lifetime golden opportunity to get rich, but then I'm going to put that money in the bank because I'm scared that over the next 5-10 years, I'm not going to keep earning money on a recurring slide. So that's why I don't think this was a major stimulus. What we need is a fiscal stimulus. We need to get money that's going to be pumped into the system 100%, where the government announces we're going to be building, new subways, new roads, whatever it is. We need to get capital flowing into the market so that there's actual job creation. The biggest problem right now, David, is job creation. because of expensive labor laws. It's difficult and expensive to fire people. So nobody wants to hire recent college grads because if the economy is bad in 9 months, they don't want to have to go through a legal process to fire them. They don't want to fire their current employees. So what they're doing is they're cutting their salaries, they're demoting them, and generally making their life hell in the hopes that the employees will quit so that you don't have to pay a major severance. So when you have this broad-based, it's really an icky, it's almost dystopian-like system that's happening right now. That's what hits consumer confidence. Triple R reserve drops is not going to all of a sudden get somebody who just had his salary cut 30% to go out and spend more.
Well, why are people expecting the economy to weaken? I mean, to your point about employers not wanting to hire people, they're expecting the economy to weaken in the next year. That is a good assumption to make. And if you're making that assumption, yeah, don't hire. But why are they making that assumption in the first place?
I think there are a couple areas. The first is, frankly, amongst the wealthy in China, there's unease, and they're not sure whether or not the CPC currently wants rich people in China. Now, I actually think the Chinese government is fine. They're not anti-business. They're not anti-wealth.
Wait, sorry, what do you mean rich people in China? What would they do with the wealthy anyway?
Well, so what's happening is a lot of them are getting arrested right now. And I don't think that's because they're anti-wealthy or against the wealthy. It's more that they did illegal things. 10 years ago, 20 years ago, they were corrupt. So it's time for them to face the music. But the reality is the system was so corrupt 10, 20 years ago that everybody who is wealthy in real estate, everybody who is wealthy in a broad swath of sectors paid bribes, did something illegal. So they're getting arrested right now. So it's very difficult to get these wealthy consumers to feel comfortable to go out and spend more again. I just don't see that happening anytime soon, David. Now, the second part, which we haven't talked about, which is actually the major theme of my book that comes out next week called The Split, Finding the Opportunities in China's Economy and the New World Order. That's looking at how U.S. and China political tension is wreaking havoc on China's economy. And so the book and what I talk about is how wealthy people don't want to start a new company. So there's very little animal spirits, very little venture capital and private equity investments going on right now, David, because wealthy Chinese, the movers and the shakers, are scared of opening a company because they're worried 5 years from now, if their company becomes a top player, the Biden regime or Kamala Harris or Trump or whoever is the next president in DC is going to continue to try to contain China. When you look at it, whenever the Chinese start to dominate any sector, literally any sector, the Americans try to contain. So the Chinese control about 90% of antibiotic production in the world. And so the United States has said Wuxi Pharmatech is a national security threat and is putting on sanctions. Huawei is an incredible company. Their products are 30 to 50% cheaper than Apple, and I think they're just as good. All of a sudden, it's a national security threat and they can't sell into the United States. Chinese NEVs like NIO, BYD, Lixiang are the best in the world, and they're destroying GM, Ford, Volkswagen in the China market. But you see, the Trudeau regime slapped a 100% tariff on Chinese NEVs to follow what Biden did in the United States. About 20% of the world's cotton comes from Xinjiang. And Xinjiang is where the United States has said there's forced labor and genocide taking place. So literally, for the wealthy Chinese, they feel if they're going to build a cotton company to a telecom company to a pharmaceutical company, if they grow, it's not the Chinese government that's going to slam them. It's the American government in a form of imperialism. And so that's why the animal spirits are gone. So if people get money in a stock market increase, they're going to say, great, let me sell this. Let me hold on to this money because this might be the last money I earn for the rest of my life, because they're very worried that the U.S. will impoverish China for decades the way the U.S. has impoverished Cuba, Iran, and North Korea.
You mentioned tariffs on EVs. Are you suggesting that broad-based tariffs across Chinese industries, the trade wars, if you want to call it that, that's hurting the Chinese more than the Americans?
Absolutely. So I think that what you're having is the tariffs that Trump started and Biden doubled down on is hurting America in terms of inflation. I mean, it doesn't take a genius to realize that since America put tariffs on China, since America ran an irresponsible, loose monetary policy during COVID, then you now have massive inflation in the United States. So that's certainly hurting the everyday Americans who have to spend more at Walmart because of Biden's China containment policies. I'm not sure why the media is not talking about this more. But the reality is this economic war, and it's almost like a 1930s like situation. We're really at the edge of, I would be worried about a hot war between the US and China. And what's happened is it's really impacted consumer sentiment because we see that American companies are no longer investing into China. So Apple is relocating a lot of their manufacturing to India. What's basically happening is that American companies are keeping their assets in China or slowly reallocating to other markets like India or Mexico, but very few are launching major new investments. It's the Europeans, the Spanish, the Germans that are still investing into China, but the Americans aren't. Neither are the Japanese and the South Koreans for that matter. And so the people living in tier 1 cities like Beijing, Shanghai, Shenzhen, or Guangzhou, people who deal with foreigners and do business with FDI-related activities, they feel the dearth of new economic growth and revenue because of America's sanctions. So I think to sum up on that, Biden is hurting China seriously, but is also shooting America in the foot by causing inflation. And by, last point before I let off is that, they've destroyed American tech's ability to be able to sell into China, right? So Intel might be acquired by Qualcomm and is tottering on the brink of as an acquisition target because it's no longer allowed to sell to Chinese clients. So Biden is hurting China and hurting the United States. He's got to be the worst president of all time.
Okay. Well, on that note, let's come back to the hardware aspect that you talked about. In your book, you've discussed changing consumer consumption patterns in China. Now, how have these consumption patterns been affected by these tariffs, or have they been affected by other domestic policies more?
Well, let's look at a sector like tourism. Okay, the Chinese tourists, about 190 million of them traveled overseas in 2019. They were the new Japanese. They were the ones that were going to the Champs-Élysées, Fifth Avenue, and going to Louis Vuitton and Gucci and buying bags and bags of Burberry and Chanel. And that's why Arnault, the founder of LVMH, is one of the world's richest men. That was built on the back of Chinese consumers. What's happened is because of all the geopolitical tension, because of the split between America and the Western world and China, Chinese don't want to travel to those countries anymore. So you don't see Chinese going to France, going to Italy, going to the U.S., going to Australia, sort of the Anglo-Saxon world in some ways, like they did before in 2019. Instead, they're going to countries that are close to China. So some of the new hotspots would be Saudi Arabia, UAE. Dubai is absolutely booming with Chinese. I was actually just in Saudi Arabia a few months ago, and they told me that 30% of the guests are now from mainland China. Chinese are starting to go back to places like Genting in Malaysia, which is a resort town. So what you're starting to see is the travel patterns are different. The second part, David, is instead of just going out and buying luxury, which is why I'm very negative on Burberry, short Gucci, people are looking more for experiences. So they're doing camping, they're doing skydiving. So I think the geopolitical tension combined with COVID has caused the Chinese consumer to focus more on health, focus more on wellness, focus more on spirituality, and tourism is sort of the winner of that. However, the tourism is spending less per capita than they did in 2019. So Chinese will still travel, but they're just not going to spend on shopping and on hotels. They're going to spend on expenses, which is harder for equity investors to gain from the changes.
What about foreign direct investment into real estate? I live in Vancouver. That's the Vancouver skyline behind me. And much of that behind me is also Chinese money over the last 25, 30 years. Now, with the Chinese property market having come down by 20 to 50%, like you said, is this FDI going to accelerate or decelerate?
So do you mean Chinese outbound?
Chinese money, yeah, Chinese outbound money into foreign real estate markets like Canada, like Vancouver, for example.
So it's very hard for the wealthy Chinese to get money out right now because
they've been doing that for the last 30 years. What changed?
So it's always been difficult, but in the last 3 to 5 years, the government has gotten more serious. They've been arresting the Huangniao, or the illegal money changer. There's always announcements of huge underground banks, 200 billion, 300 billion that have been arrested. So I've never tried it, but when I talk to wealthy people in the last 6 to 12 months, they've told me it's much more difficult to get money out than it was in previous years. That's why so many Chinese are buying Bitcoin. That's why they're buying gold, because it's an easier way to get money out. The other thing, David, that wealthy Chinese are doing are immigrating. So if you become a foreign passport holder, you are then allowed to sell your house and transfer that money overseas. So that's actually one of the reasons why the wealthy, like I said, was like the wealthy neighborhoods like my own, some of the housing prices have dropped because some people are immigrating and they're uber rich. And so they sell their house and they just want to get their money out as soon as possible so they can buy a home in Australia or in Vancouver or in Irvine, California. So they'll say, you know what, this is my one chance to immigrate, my one chance to sell my real estate. Even if it's a 25 to 50% drop, I'll take it, because they don't know if that window of being legally allowed to convert their money will remain open. So that's another reason why housing prices have dropped so much. It's the only way people can legally get money out if they take on a foreign passport. So right now, the only people in business who are really happy in China right now are probably the immigration consultants, the education consultants who help wealthy people send their kids overseas, and labor lawyers, because there's so much fighting right now in the labor markets.
On the property market of China, this new stimulus package promises to reduce the minimum down payment ratio to 15% from the current 25% nationwide. Like I mentioned in the opening, they're also reducing mortgage rates by 0.5 percentage points. Some analysts expect this to be beneficial for homeowners. They could save up to 150 billion yuan less in interest a year. More than 50 million households are expected to be affected by this. Will this be enough to turn the market around, the property market in China?
No, it's not enough. I think it's enough, again, that 20 billion US or so, when you're saying 150 billion in RMB savings on interest rates, people will just take that money and, again, save it, because they're going to be scared that they're not going to be able to have recurring income in the coming months or coming years because of the geopolitical tension. I do think that the lowering some of the policies will help a little bit, but like Shanghai, for instance, said that if you don't come from Shanghai originally, if you're not a Shanghai hukou holder, you have to live in Shanghai for 3 years, pay income tax before you're allowed to buy a home. Now they've dropped that down to 1 year. That's not going to make much difference, because who moved to Shanghai 3 years ago? That was in the middle of zero COVID hell. So you're only talking dozens, hundreds of people who potentially could buy a home from these new policies. So I think it's piecemeal. Now, when it comes to real estate, David, frankly, I don't think the government wants to stabilize it too much. I think they want to stabilize a bottom. I think they're okay with the 20 to 30% drop from the highs, but they don't want to reinflate what they consider to be a bubble, because too much money was going into real estate. It was making housing unaffordable for everyday Chinese, and it was at risk of causing a systemic financial threat to the economy. I actually think that a 10-20% drop, if you hit rock bottom and you hit stabilization in real estate, that's enough. I think some of these policies might get there. I think you'll probably need to see a few more mini policy changes over the coming 3 to 6 months before you truly hit rock bottom. But I'm actually intellectually okay with that. That's actually why I think the government wants to pump up capital markets. So they don't want a thriving, booming real estate sector. They want to find new drivers for the economy. And I think they understand they need a healthy capital market in order to promote the economy. So that's why in the medium to long term, I'm actually very bullish on A shares, because I think the government wants to have the A share market to go up, because that will help every Chinese get wealthy and then feel like they can go out and spend. You got to remember, in China, only about 10% of people have bought stocks. In the United States, it's 70%. So I think China, there's a lot of savings, a lot of money sitting on the side, that if you can get those everyday Chinese workers to put money into the A shares and the capital markets, that's going to be very good for the economy. I view the mortgage policies and changes of the last couple of weeks as trying to hit bottom, stabilize low prices, not to try to get prices to go up again. It's very incremental. And I use that term incremental because the Chinese government keeps using it. They say incremental, incremental, incremental when it comes to new policies to jumpstart the economy. They don't talk about a bazooka-like stimulus coming. I think Wall Street has gotten a little ahead of itself. I don't see the Chinese government panicking about the weak state of the economy because it's still growing about 4.5%, 5%. It's just the government wants to do tweaks like the mini stimulus for the capital markets.
So you're bullish Chinese equities. I like to play this clip for you. This is from American investor David Tepper. He was on CNBC talking about Chinese equities. Take a listen to this 30-second clip.
The Europeans are lowering rates. And now the Chinese are lowering rates, okay? And they're aggressive in how they're going to do it. And they're also, believe this or not, swap facilities to buy stocks. Encouraging buyback of stocks. Encouraging buybacks of stocks. Okay, this is China, all right? This is stock buybacks. Not only encouraging it, lending you money to do it. And they're giving money like TELF money where you can put money out and you have no losses. If you want to do it, you know how that thing works. You have only the money you put up, and you don't lose money. That's a great deal for me. I want to be over there and borrow for some of this stuff.
Later on, he goes to say that his allocation to China exceeded his normal allocation to foreign equities, but because he's very, very bullish for a lot of the reasons, one of the reasons he just stated. Can you comment or respond to what he just said?
Yeah, I think Tepper's completely right. And that's why I've been one of the biggest bulls on the equity markets for the last couple months. So there's a difference. I've been very concerned about the economy in August and September, but that's also the time that I started telling my hedge fund and mutual fund clients, now's the time to look at China again. You know, the P ratios had dropped too much. There's down 8, 9. Now it's around 12 or 13, while Japan is 18. I've met, David, about 100, 200 hedge funds in the last couple months, and they thought China was uninvestable. I sat down with someone as famous and as wealthy as David Tepper, and he looked at me and he said, Shaun, I will never invest in China again. It's uninvestable. China wants to go back to a Maoist period like during the Cultural Revolution. It's ridiculous. People were fleeing in the U.S., people were fleeing the Chinese equity markets because they thought a cultural revolution was happening. I mean, the misinformation, disinformation on what's going on the ground has been sensationalized. Again, I've been very clear. I was very negative and very pessimistic on the economy, but it's not that bad. The economy is weak, but it's not that weak. Unemployment is still only around 5%. You know, the GDP is still going to grow 4.5%, 5% this year and next year, which is why the government hasn't been panicking. It's just been an ugly situation for consumer confidence. But Tepper's right. It was time for the equity markets to go up because the valuations were too low. China is still investable. We're not having the chaos of the Cultural Revolution hitting the country again. I don't know why the New York Times, why the Wall Street Journal echo a lot of this time period and era in their criticisms of the current Chinese economic policies. It's blatant sensationalism or lies. So Tepper's right. It was a great time. But here's the problem. I don't know the exact day that Tepper said that, but the Hang Seng went up 38% from the lows. So you're starting to hit a point of, is there too much frothiness? I've long said, last week, I went on CNBC and I said that the Chinese equity markets could go up another 10, 30% over the next 1 to 3 weeks. So I think there's going to be a lot of volatility in the coming week. You're going to see 5, 10% gains, 5, 10% drops. I think now is a good time to buy on the day that it drops because it's going to go up the next day and then sell. It's very hard to be a long-term investor in this type of environment. You need to be investing on a day-by-day basis. But I think the equity markets still have room to run because of the reasons that Tepper outlined, and because I think valuations were too low and people put too much exuberance into India and too much exuberance into Japan. I'm not an expert on India, but I think that valuations are too frothy, certainly in Japan. And I think you're going to see some money retreating from the Japanese market and coming back into China over the next couple months.
Okay, I have 2 more questions on stocks, and then I'd like to close off on your geopolitical aspects of your book, Shaun. The questions I have, investors may be wary of going back into Chinese stocks because, A, The 2014 A-shares bubble collapsed, wiping out nearly 40% gains pretty much in the span of days, right? That's still etched in people's memories. What's different this time? And the second question is, people are concerned about the Chinese economy turning into Japan in the 1990s. Can you address both of these concerns?
So I don't think you can invest in China long term. You can't be an investor that buys stocks and holds it for 5 years and forget about it. So if you remember 2014, if you remember some of the volatility in past years, you need to find a company that you like and hold it at most 3 to 6 months. Again, you might need to be thinking in weeks, maybe even days and holding, because the volatility is so high. One of the problems is so much of the asset allocation owned in the Hong Kong exchange is owned by Americans and Europeans who don't have a real understanding of what's going on the ground in China. Many of them haven't been to China in 5 years. You know, I was talking earlier this week with a hedge fund manager, and he asked me, Shaun, is it safe for me to go to China, or will I get arrested? You know, which just doesn't make any sense to me. But the Wall Street Journal was saying that Americans were randomly being arrested. I think this is the safest country in the world for Americans, aside from maybe Singapore. But so I think the reality is you can't invest long-term in China unless you really have your eyes and ears on the ground. You have to be very cautious if you're a retail investor, but you're going to have a great boom over the next 1 to 3 weeks. If you let the fears get into you, you'll miss out on the 38% growth in the last couple of weeks. So a lot of my clients who poo-pooed me and said I was crazy when I told them to buy in August are now calling me and apologizing and saying that I was right and that they missed out on what should have been their biggest bonus of all time. Now, in terms of China becoming stagflation or becoming like Japan, I think there's some similarities, but there are also a lot of differences. I think the first is, for me, Japan really got hit because they signed the Plaza Accords, where Reagan forced them to increase or appreciate the value of the yen. They also forced Toshiba and a lot of those companies not to make semiconductors and sell into China. That's actually a whole chapter of my book where I look at why Japan got destroyed in the 1980s and 1990s because of American bullying. I think the Chinese learned from that mistake, which is why instead of bowing down to the Americans, they're still pushing money into companies like SMIC, into companies like Huawei. That's number one. So there's a lot more vibrant innovation taking place in China than it did in Japan. The second thing is the Chinese are not going to appreciate the renminbi. They're going to continue to keep it relatively okay price so that China can continue to dominate in manufacturing and dominate in exports. And you see the export sector for China has held up pretty strong this year. China remains the world's factory. And I think also very importantly is you got to remember Japan, because of its legacy of World War II, was and still hated by a lot of countries in its neighbors. So in the 80s and now you see the Thailands, the Malaysias, the Singapores, the Koreas didn't want to do a lot of business with Japan. They did business with Japan because they had to, because it was an economic might, but there wasn't a lot of happiness. While with China actually, it's portrayed differently in the Western press, but actually has very good relations with a lot of its neighbors. It has great relations with Singapore and Thailand and Malaysia and Indonesia. So I think, and the rest of the global South, Saudi Arabia, Kenya, they're making great inroads into Latin America. So I think China is going to have far more robust trade activity, imports and exports with countries in the global South in the coming 10, 20 years than Japan did in the 1980s. I think a lot of global South nations feel that Biden is bullying China. Biden and the U.S. has lost a lot of credibility with what many in the global South see as hypocritical standards between Ukraine and Russia and Gaza and the Palestinians and Israel and the IDF and what's happening there. So I think a lot more of the global South nations are moving closer and closer to China's economic orbit. So I think when you do a very cursory glance, yeah, there are similarities between China and Japan. You've got the real estate collapse. You've got the equity collapse. You have an aging population. But when you dig down deeper, China's in a much better position to continue to grow, which was one of the major themes and arguments of my book, The Split.
Let's finish off on the geopolitical chapters of your book. What ultimately is the progression or the evolution of U.S.-Sino relationships as discussed in your book? Where is this headed is my question.
So I think the fear in China, which I mentioned before, is that no matter what China does, they're going to be blamed by DC and viewed as an existential threat, who's threatening the value system, threatening the way of life for America. It seems that the warmongers, the bigots, and the imperialists are now controlling DC discussions. I don't think China is a threat. I think China wants to be they sort of want a unipolar world in Asia, but a multipolar world globally. I don't see China wanting to contest America's way of life or power in any way. But I think unless we get a pragmatic president, maybe that in the US, that I don't see relations getting better. And that's again why the 10%, the wealthy Chinese, are so scared about investing or buying things, because they worry that China's going to become poor like Iran has done because of American sanctions. Now, the only hope is you get a president like Trump. He's kind of a wild card, right? He started the trade war against China. He says he wants to slap 60% tariffs, but the Chinese feel, might be transactional. He might be able to work out a business deal with China where he has said, I don't want Chinese NEVs to come into the United States through exports. I don't want the BYDs and the Li Xiangs and the Neos to export into China. To export into the US. I want them to build factories in the US and hire American workers. Now, frankly, David, that's fair, right? That's what the Chinese did to the Americans. They made Buick open up factories in China and then open up the market. So if Trump wins and he's pragmatic, then we might see an improvement of relations. The problem right now is Biden doesn't want America to ever see Chinese NEVs. That's why he puts the tariffs. That's why he's saying he might ban completely any software from the auto side made in China. I mean, it's ridiculous. I think in many ways, Biden has become what he used to accuse China of doing with the censorship, the protectionism, and blocking out. I think what Biden's doing is un-American. And my hope is that the next president, whether it be Harris or Trump, they become more pragmatic and try to improve relations with China. It's not a zero-sum game. I don't see that happening, frankly, under Harris and Waltz, because they're ideologues like Biden. I think there's a chance for slightly improved relations with Trump, because I think he views everything through a business economic lens, and he really doesn't want to warmonger. I consider the Biden regime to be one of the biggest warmongering regimes that the world has ever seen, frankly.
Well, let's close off here. Speaking of a hot war, one of the major points of dissension between the West and the East is on Taiwan. So let's just lay out the facts here on Taiwan. The Taiwan Mutual Defense Treaty between the U.S. does not clearly state that the U.S. has to provide direct military support for Taiwan in the case of an attack. However, Biden did say verbally several times that he would defend Taiwan if China invades. China never said that it wants to invade right away. However, a lot of military analysts and high-level military leaders in the U.S. have speculated that the deadline for invasion is coming up because, like you pointed out, the economy is weakening, growth is slowing, and so she's losing power. And so if he's losing power, he would want to act quickly. What do you make of all this, and what's your assessment of the situation?
American military analysts might be the dumbest people in the world. They couldn't even figure out how to beat the Taliban in Afghanistan. Basically, here's the problem with the United States' whole military machine. The military guys want to get famous. They want to say there's a threat, so they get famous on TV. They get more power internally, so that once they retire, they can go work for Carlyle Group or KKR. And you see, like the former head of the NATO for the U.S., Jim Cerveris, is now working in private equity, making millions and millions. So for their own selfish purposes, it's good for these military people to say there's a threat. Now, let's take a look. Is there actually a threat? There's always the risk of war because China has said that it wants to reunify with Taiwan. But it's very clear to me that they don't want to use a hot war. They want to try to buy the support of Taiwanese businessmen and sort of slowly have integration. And that's something that's also outlined in my book, The Split. In the last couple of months, they've made it, and they've released a bevy of policies that are very favorable to Taiwanese businessmen. If they invest in Fujian province, which is the province closest to the Taiwan province, if they invest there, if they send their kids to school there, if they get medical care, they've got huge policies that make it very beneficial for Taiwanese. So basically, China wants to integrate the economies and integrate the people. You've also seen that China, even Xi Jinping himself, met the former president of Taiwan, Ma, in China. They've been meeting a lot of the senior KMT or Kuomintang officials. Now, right now, it's the DPP who's in charge, but I think China is launching a charm offensive on the Kuomintang KMT powers, because the hope is that the Kuomintang will become the next president in several years and could move towards reunification. I'm not overly concerned about a hot war over Taiwan. I think that's being trumped up and sensationalized by very selfish and ignorant military leaders and analysts in the United States. The much bigger risk, frankly, David, is the Philippines. In the last couple of months, you've seen under Bongbong Marcos, I would consider the Philippines trying to provoke China. So Chinese view that the Americans and NATO provoked Russia over Ukraine, and they're trying to do the same over the Philippines. You see a couple things have happened. Just last week or 2 weeks ago, the Philippines announced that it wants to permanently install American missiles in the Philippines. That's a direct act of provocation. Now, you don't hear much about this in the Western press. And when China retaliates with something, the American media from the New York Times or the Wall Street Journal will say, this is an unprecedented, unprovoked attack by the Chinese. But they forget that the Philippines put in the missiles. That's the bigger concern, David, much more than Taiwan.
And final point, this is something I've been wondering myself. If Taiwan and China were to reunify peacefully, per your theory, how would the U.S. react? The U.S. can't stop a peaceful reunification, but at the same time, it'll lose a sphere of influence.
Yeah, that's an issue because they're worried about losing out the semiconductors like TSMC. My guess is, America, the Congress announced that they passed a $1.6 billion package to spread anti-China messages in global media. And so I think you're going to see a ramping up of attacks on China. You might even see sort of a yellow revolution. I think there's a feeling within China that the Hong Kong protests of 2019 were aided and abetted by, the National Endowment for Democracy or the CIA. My guess is if there was a peaceful integration with Taiwan, that the Americans would certainly fund an underground element to try to push for protests or civil unrest and maybe even armed unrest. I think a lot of people don't realize just how violent 2019 was. I mean, I was there, I interviewed a lot of the people throwing Molotov cocktails. That was not peaceful at all. That was far more violent than Capitol Hill on January 6th in the United States. And it went on for, over half a year.
Shaun, excellent. Thank you very much for your interview. We can find your book. Where and when? When does it come out?
Thank you so much for having me, David. It was a real pleasure. I'm glad we were able to make this work because I know you reached out to me 6 months ago. Always happy to talk to a fellow McGill alum. My book, The Split, Finding the Opportunities in China's Economy and the New World Order, comes out October 22nd. Bookstores all around the world, but the best and cheapest way is probably to buy on Amazon. I hate to give Amazon a little blurb because I don't like the company, but that is unfortunately the best way to buy the book. So great talking to you, David. Hope the audience enjoyed it. Bye.
I learned a lot talking to you just in the last 30 minutes, so I think it'll be a great read, and I look forward to it. Thanks for sending me the book, by the way. I look forward to reading it. So thank you. Where else can we learn from you? Can we follow you anywhere else?
I think the best way to find me is in my books, or I'm very active on LinkedIn and Twitter, so you can find me there. And I hit CNBC every week or two.
All right. Thank you very much, Shaun. Take care.
Thank you.
Thank you for watching. Don't forget to like and subscribe.